The dust settled following the stunning news that Great Britain would break away from the European Union. The vote by Britons had set off a 3.5% plunge in the Standard & Poor's 500 index on Friday, June 24th, and dropped another 1.8% the following Monday, a sell-off of 5.3%. In the 4 days that have since followed the sell-off, the S&P 500 is about back to where it was before the Brexit crisis erupted. Likewise, the European and UK stock markets recovered sharply from their lows. While regulators require that we remind you past performance is not a guarantee of your future results, the truth is that the Brexit stock plunge and snapback was not unexpected. Within hours of the initial 3.5% plunge in stock prices, we sent out a message saying Brexit is a political crisis, not an economic one, and certainly not for the United States. Great Britain and the European Union account for 2% of U.S. gross domestic product, according to Shahryar Antia, a former senior analyst at the New York Federal Reserve Bank. Even if all trade with Great Britain and the EU were to end, the impact on the U.S. economy would be minimal. Brexit may cause a recession in Great Britain, but that does not change the forecast for the American economy. And the news is good on that score. In early June, the 70 economists surveyed regularly by the Wall Street Journal forecast that the average rate of quarterly GDP growth for the rest of 2016 will be 2.4%. That's good news. Despite weakness in the first quarter of 2016, this is a Goldilocks forecast, growth with low inflation. New personal income and spending figures through May 2016 were also released. Brexit headlines overshadowed the good news about continued strength in income and spending growth. Keep in mind, personal outlays account for 69% of U.S. economic activity. As they go, so goes the U.S. economy. Real disposable income per capita, a key measure of inflation-adjusted purchasing power, grew at a 2.5% rate over the 12 months ended in May. That's higher growth in income and spending than during the last economic boom. That's good. Finally, the monthly data from the Institute of Supply Management on Manufacturing was just released, and it showed a rebound, and of course, that's good news. But what could be even better news is buried in the numbers. The ISM Manufacturing Index is comprised of numerous components, and one of them, the New Orders Subindex, rose to a strong 57% reading. This suggests orders are in the pipeline. It suggests further strength in manufacturing in the weeks immediately ahead. Considering the panic selling only 6 trading days ago, when the Brexit crisis erupted, this was a very good week for economic news. On this 4th of July, a day to be grateful to be an American, it's a reminder that the U.S. is an exceptional nation.